Every time the economy crashes, the same thing happens. The rich get richer, and everyone else gets wrecked. In 2008, they scooped up foreclosures for next to nothing. In 2020, while millions scrambled to make rent, billionaires gained trillions. It's not a conspiracy. It's not insider trading. And it's not because they're smarter or luckier. It's because they've been taught a system most people never learn. A system that turns recessions into once-in-a-decade buying opportunities. Today on Clip Capital, we're pulling back the curtain on how the rich actually use recessions to multiply wealth, and how you can start thinking and investing the same way, even without a fortune. Let's get into it. Here's the first mindset shift. A recession is not a financial apocalypse. It's not just lost jobs, lost security, or a scary news headline. It's a reset. And during that reset, one of the biggest wealth transfers in history quietly unfolds. When the world hears crash, they retreat. When the wealthy hear crash, they reload. Because to them, a recession is like a fire sale. Everything is marked down. Stocks, real estate, private businesses, even labor and services. The wealthy aren't just weathering the storm. They're buying the neighborhood while the rest of us are boarding up the windows. Let's talk about the crisis discount. This is when fear overtakes logic, and people start panic selling assets way below their true value. Imagine a house worth $500,000 dropping to $320,000 in a crash. Nothing's wrong with the house. It's still the same property. The only reason it's cheaper is because the owner is desperate, and no one is buying. That's not just a deal. It's a discounted wealth engine. Same with businesses, same with stocks. Amazon stock once dropped to $6 from over $100. Did Amazon change? Number. Investors just lost their nerve. People who bought at $6. Multimillionaires now. Recessions don't destroy wealth. They redistribute it, from panicked hands to prepared ones. The second advantage the wealthy use is liquidity. Cash. The average person invests everything when markets are booming. Every dollar into stocks, crypto, real estate. Because why not? Everything's going up. But when the crash hits, and they lose their job, or a big emergency hits, they're forced to sell at the bottom, exactly when prices are lowest. That's how people lose decades of savings in weeks. Meanwhile, the wealthy have been holding dry powder, not because they're scared, but because they're waiting. When assets drop, they're not forced sellers. They're eager buyers. They swoop in and grab those discounted investments. And when the economy recovers, they don't just bounce back. They come out way ahead. Example, investor A puts $50,000 into index funds in 2007. 2008 hits. They panic sell at $25,000. Investor B puts $30,000 in, holds $20,000 in cash. Market drops, but they use the cash to buy more. Fast forward to 2010. Investor A is trying to recover. Investor B's assets have doubled. Same starting amount, different outcome. Now let's talk about income insurance. Most people have one stream of income, their job. And in a recession, that stream is at risk. Layoffs, pay cuts, hours reduced. The wealthy, they've built multiple streams. Rental properties, dividends, royalties, business profits, investments that pay them every month. So even if one slows down, the others keep flowing. And during recessions, they're actually building more of these streams at a discount. They buy rental properties when home prices fall. They buy dividend stocks when yields skyrocket due to price drops. They buy entire companies when founders are burned out and looking to exit cheap. This is how wealth scales, not just by earning more, but by stacking reliable, recession-proof income streams. This one hurts, but most people were never taught how money actually works. They know how to earn it, maybe how to save it. But what's an asset versus liability? How do you analyze a stock's intrinsic value? What's a good cash-on-cash return for a property? Crickets. Meanwhile, wealthy people spend years, decades, learning how to read financial statements, how to value companies, how market cycles work, how to spot fake opportunities and find the real ones. They don't follow headlines, they follow fundamentals. In a recession, this becomes their superpower. While most investors sell because it feels right, the wealthy buy because the numbers tell them it's a good deal. Here's a hard truth. Most people can't wait. They want fast returns, quick wins, immediate results. But building wealth in a recession takes time. Assets usually drop more before they bounce back. You might buy a stock at $40 and watch it drop to $28. If you panic, you've lost. But if you understand value and have patience, you'll likely see it go to $60, $80, even $100 plus over the next few years. Wealth allows patience. Patience builds more wealth, and the cycle repeats. The rich aren't more talented. They've just been through the cycle more often. They know this too shall pass, and they're willing to hold while others fold. At the end of the day, the biggest difference isn't money, it's psychology. Most people operate from scarcity. They're terrified of losing what little they have, so they play defense. The rich operate from abundance, not because they're reckless, but but because they've built safety nets. They've built margin, options, time, and confidence. So while most people are selling off their future out of fear, the wealthy are buying it at a discount. Let's be real. This system, it does favor those with resources. But here's what they don't want you to know. You can build these same advantages. Start small, save up a cash buffer, learn to evaluate investments, build a side hustle that earns while you sleep. Train yourself to stay calm in chaos. You won't win every time, but each cycle you'll get better. Your first recession might just be survival. Your second might be stability. By your third, you'll be ready to thrive. The next recession is already forming. No one knows when, but it's coming. And when it does, money will move from those who panic to those who are prepared. So ask yourself, will you be forced to sell at the bottom, or will you be buying the future on clearance? At Clip Capital, we're here to make sure it's the latter. Stick around. We're just getting started.